This is Abhijit Chatterjee recording our weekly session for Chartsarefun. This is for the last week of July, the week of July 27th. Recording this on Saturday, August 1st in the evening. Our blog site, which is daily blogs, is at Substack, chartsarefun.substack.com. And then our YouTube channel is also Chartsarefun. We do believe there are tremendous fun insights in these charts. We really appreciate you subscribing to our channel. And then if you like the videos, we really appreciate you, hitting the like button. Today we're going to talk about repeating from last week. A key indicator for the market's direction is long-term yields, in particular 10-year Treasury yield. We showed this pennant pattern. We talked about this breaking higher is not good for the market. Higher yield in Treasuries means more kind of the bond market, which is often called the smarter part of the market, getting nervous about inflation, getting nervous about Fed's ability to curb inflation, and often the cost of capital rises, and inflation is never good for the market. So we talked about this long-term pennant pattern, this declining trend of tops and these rising trend of bottoms. Breaking above it, 2 successive weeks. We can see 2 weeks of next week, the previous week and this week of climbing trend. And what happened was this week was the FOMC meeting. Chair Kevin Warsh said that from the FOMC perspective, they had decided, all 12 members, that the final decision was to hold rates steady. That's between the 3.5 to 3.75. That said, if you looked at the voting members, there were 12. 9 of them voted to keep it steady, but 3 members voted for a 25 basis point rate hike. Market saw the dissents as a signal of a rate hike coming in the next FOMC meeting in September. So that's where we can see that we had the 10-year yield climb further, almost towards 4.75% is where it closed. And if this continues, this could be bearish for the market. That said, if you look at, this is the weekly chart, right? And we show that pennant breakout and 2 successive weeks of climb. We've had a similar kind of a breakout in May of 2026. That turned out to be a fake out, and then it pulled right back below. So let's look at shorter term chart of the 10-year yield, the TNX. And we find a very interesting pattern, which is actually a pattern that indicates a reversal could be coming. A reversal in the sense that this is called a rising wedge pattern. So you're joining the higher highs and the higher lows and kind of converging towards an apex. In this rising wedge pattern, if it follows with negative divergence, which is the relative strength index printing lower highs, and the moving average convergence divergence, the MACD, printing lower highs. This indicates that a climbing wedge with declining momentum, as in momentum on RSI and MACD is not printed higher highs yet. This flags potentially this rising trend to reverse and this breaking below this lower trend line and coming back from where it started at 4.36. There's a potential possibility of that happening. Bond bears, in terms of higher yields, means that bond prices come down, and that's what the bears are looking for. Are, however, looking for this to be a breakout from a 3.6 to a 4.8. That's 1.2% added to 4.8, a minimum climb to 6% or higher. That's what bond bears are looking for, the yields to continue to climb and 10-year yield going north of 6%. That would not be good for the market. So we just got to be careful. However, earnings rules the market. S&P 500, QQQ, it all is powered by earnings. 2 strong earnings related moves happen. So Wednesday was the day after the 10-year yield, had that was Wednesday, Thursday, Friday. It kept climbing to the top end of the trend line. But that rising trend of yields came after the FOMC decision. Though, as we said, the rates were steady, those 3 descents market reads as a chance of a hawkish Fed turning around. 3 descents could turn to 5 descents if we turn around, everyone voting for a rate hike in September. The 2 key earnings that turned around the market. So Wednesday, the market ended negative. It ended in a very bearish fashion. Something else happened in the market, by the way, on Wednesday. There was a big liquidation of a hedge fund. Situational Awareness is the name of the fund. A young kid, 24-year-old person, a data scientist from OpenAI, started this hedge fund. Tremendous amount of leveraging. He had taken 4x margin. Typically, you take 100% margin. He took 400% margin. From who were his prime brokers that gave him that margin? Bank of America, JP Morgan Chase, Goldman, the biggest of the biggest banks in Wall Street. They lured him into investing, and his big bet was an AI. So Eschenbrenner, this guy, Leopold Eschenbrenner, he betted on these big, CoreWeave, all the AI related stocks, CoreWeave, he betted on Micron, SanDisk, he betted on SK Hynix, all going up, continuing to going up, not realizing that you do get nothing goes up to the moon, market goes in cycles, you get corrections. And that correction was pretty sharp. Over 30% correction in the semiconductor index from that June 22nd peak happened, and that caught him off guard with his leverage, and he had to start liquidating. Citadel stepped in, which is a very well-known Wall Street firm, to bail him out, but buying his assets dirt cheap. So that happened on Wednesday into Thursday is why we had a very sharp drawdown onto Wednesday. Now, what were the two key earnings this week that turned the markets, moved around, and QQQ turned back significantly higher going into Thursday and Friday? First was Microsoft on Wednesday. Microsoft's chart on the daily chart shows a beautiful double bottom. We've talked about it before. How do double bottoms form? Double bottoms form when you test that previous bottom, which is at a key bottom at 355, tested it at a slightly lower bottom at 349, call it at 350, where the bottom was, with higher momentum, as in higher low in RSI. That is how double bottoms form, and this turned out to be a beautiful double bottom. Now, for it to be confirmed, Microsoft needs to take out its W, the tip of the W at 466. It took it out from our intraday high on Friday, by the way. 466.84 was the high printed on Friday. What was the previous high from early June? 466.32. Look at the bullish candle. Two gapped higher after the earnings on Wednesday into Thursday and Friday. And look at from there, if this breaks this W shape, just the measurement of the W shape from a 350 to a 466, $166 added to 466, that's 582. That's above the previous peak around 550, 650, not 582. Yeah, the previous peak was around 550. It's going to go towards 582 is where Microsoft could climb towards. Amazon, similar kind of a double bottom, a beautiful double bottom at 225. It tested the second time at 226. Similar kind of positive divergence in RSI and MACD. That breakout, that W was at 258. It opened above that. That could be as bullish as it get. It didn't even for Microsoft stop at the W. It opened, it gapped higher above the tip of the W and started climbing. So if we take a measurement from a 225 to a 258, that's $33. Add that to 258, that's 291. That's just the minimum target that Amazon is headed towards. So two big hyperscalers announced strong earnings, continue to invest on CapEx. Microsoft CapEx was projected anywhere around 190 billion or so. They had some kind of adjustments to how they count CapEx because of how they're amortizing the capital expense. Effectively came down slightly to 175. They didn't increase their CapEx. They kept it steady. And Amazon raised their CapEx from a low end of 200 billion to 220 billion. So that CapEx spending, and by the way, others also increased their CapEx spending. Meta increased it from 135 billion to 145 billion. Google, the previous week, increased their CapEx spending from midpoint was somewhere around 185 billion was Google's midpoint CapEx, was now raised to a midpoint of 200 billion of 2026 CapEx, 15 billion raise. All of this CapEx spending raise helped the market from a semiconductor perspective get a good reversal. So let's look at SOXX. This is the daily chart of the semiconductor ETF SOXX. This is a head and shoulder pattern. The key neckline is around 536. The head is around 656. That's $120. Subtract 120 from 636. That measures to 416. That's like just a little above the 200 period moving average at 402. But guess where it tested and climbed the semiconductor ETF right at a key support level from the April high at 463, 464. It tested 464, bounced back higher, 2 consecutive days of climb because of the raised capex spending from these hyperscalers into Thursday into Friday. But this candle, when you get a black filled candle, a hollow candle, white hollow candle is always bullish. But whenever you get a filled candle, whether it's red or a black, filled candles mean during the day there was distribution. So market closes below where it opens. So if it closes below its open, that's often a filled candle. So that's the red when it ends negative for the day. Black means it ended positive for the day, but by not a lot. Only 36 cents is all it closed positive for the day. But throughout the day, it opened at its high, almost near 532 and closed near 504. So that's distribution during the day. So that's potentially a near-term bearish candle. So now if you look at SOXX's channel on the daily pattern, so on the same daily chart, this is kind of a declining channel. And where did it fail? Right at the top of that declining trend line. So the lower lows and the lower highs, that channel is where it failed. If this now comes and breaks below, that's what we got to watch. Key indicators will be Treasury yields. If the bond market sells off and yields keep climbing, expect semiconductors to start have more selling. If SOX sells off and this breaks this channel, a test of the 200 period moving average at 402 and that head and shoulder breakdown that we talked about from a 536 to a 656, $120 of 536, 416 is very much possible. Now let's look at the bigger NASDAQ 100 QQQ. We've talked about this last week. This is a classic descending triangle pattern that breakdown from a 685 with a move at about 747. That's $62. Subtract 62 from 685, that's 623. That's the measure target, which is in this particular case, 623 is slightly below the rising 50 period moving average, or in fact, that's at 633. $10 below that is at target 623. However, what happened during the week? Well, we got a bullish hammer candle. It ended positive for the week. It did break down from that descending triangle. It printed a low at 651. 661. That happened on Wednesday. Thursday, Friday, it recovered higher and ended positive with strong volume. Yes, there's a MACD bearish cross. Yes, RSI from an extreme overbought level is pulled back at the key midpoint level near 50 from where it could turn higher. This could be, for the bulls, an advantage over the bears. Bears have looked for this to break down further. This week that just crossed, bulls got an advantage because of strong hyperscaler, especially of the two big ones from Amazon and Microsoft. They won an advantage over the bears, ended up closing positive for the week, ended up closing plus 0.55% for the week with a bullish hammer candle where it opened and closed near where it started the week with a strong volume. This could indicate maybe QQQ has seen its bottom for the near term and could continue a climb. However, what we need to watch is this pattern that we see here is actually a falling wedge pattern, which we had back in the January to the March timeframe. Join the lower lows, join the lower highs. Till the very end, it was following that pattern till it broke down, only for a couple of days in end of March. And then in a V-shape, sharp V-shaped recovery with that strong volume on the reversal in the first part of April, it never looked back. A similar kind of a falling wedge pattern is repeating. Falling wedges are typically bullish patterns. Usually it causes a reversal higher. So if this falling wedge pattern ends up in a bullish pattern, then the next climb could continue for next several months. So key is QQQ needs to break above. So where did it stop? Right at 695 is where we can see the top end, the trend line of the wedge is. If it breaks 695, the next key is then it has to start printing higher highs. For that to print higher high, it has to take out 710. That was the previous high, before the 695. So it has to take out 710. It has to then take out the 50 period moving average, which is at 714. And then we are off to the races to maybe take out 747 and go above 800 to higher highs. That's a possibility. That said, if this ends up like what we saw here, a temporary break below that wedge, maybe test out that 200 period moving average. Another key support, yes, one is that support at 643 is where the 200 period moving average is. Another key support is the previous double peak that we saw in October of 2025 and into January of 2026. Where is that level? 635. So between the 643, the 635, and potentially if this descending triangle pattern breakdown comes up to the 623 target, those are potentially some downside targets that could pan out in this chart. So we have to see if a repetition of what happened in March happens. We get some form of a breakdown, a capitulation move down towards a quick test of the 200, and then from there maybe a recovery higher like we saw here. Now, a couple of technical indicators of the NASDAQ. One of them is the summation index. This is kind of a intermediate term cycle indicator. It cycles from extreme oversold levels of RSI below 10 to the single digits to RSI over 85.90. So we just crossed one of those from the April climb into May. And then from there, we've been printing lower, like a declining pattern, where now RSI on the Nasdaq summation, McClellan summation index is at single digits, is at near 9. We've seen that same kind of deeply oversold levels in March, and we saw that in November, the last two big pullbacks in the Nasdaq. However, time-wise, whenever this pulls back below that 30 line from a oversold level, it continues for a span of 3 weeks. Like we see here, it did that around early November. For the first, second, 3 weeks, it kind of bottoms out and then starts climbing. Here, same thing. For 1 to 3 weeks, it bottomed out and then started climbing. So far, we've only done 2 weeks. The previous week and this week. Another week is left. We got to see if this momentum on the bearish side peaks out, because we already got oversold levels. RSI on the summation index is at single digits. Another week maybe, and then if that climbs, that indicates this is kind of the majority of the NASDAQ stocks. If that starts climbing, that could be a reversal potentially in the NASDAQ from a bullish perspective. A bullish sign, though, is what we call as the bullish percent index of the NASDAQ 100. That we had talked about last week as well, and we said, look, it had been testing similar levels like we saw at the previous bottoms in March and in November, in that 29.30 level. This was last Friday's print at 30.39, slightly above the 30 and the 29. So we had at that time said potentially we could expect the market to rebound from these oversold levels of NASDAQ. RSI had come close to the 30. And guess what happened? This week, though the market printed lower lows, QQQ broke 685 this week, came down to test a level at 661. Bullish percent index did not look back. It climbed the entire week, higher highs for 5 consecutive days this week in the trading. Bullish percent index climbed. That's a bullish contrarian sign, by the way. It could mean the bulls have an advantage. Another signal for the bulls having an advantage over the bears. So in summary, we are looking definitely at the 10-year yields pennant breakout. This is a multi-month, over 3-year span, this pattern formed. That breakout took successive weeks of climb. If this pattern of climb continues and the 10-year yield runs towards 6% with a very hawkish Fed taking a very firm stance of getting inflation down to 2%, and as a result being very hawkish on the interest rates, this could not be good for the market. That said, potentially this could be a fake out. We could get the 10-year yield break down from this rising wedge pattern with a negative divergence in RSI and MACD, and that could be bullish for the market. If 10-year yield turns out to be back below 4.7 and comes down to, typically wedges come down to where they start at 4.36, that would be a kind of a nice like opportunity for bulls to continue the run higher, both on the bond side and taking that as a signal for the stock market to continue climbing higher. Microsoft and Amazon, the two big AI players from a hyperscaler, strong earnings, big breakouts, both with beautiful double bottom shape breakouts. Microsoft's breakout above 466, it did print a higher high, close slightly below it, but if that continued climb happens, that breakout from a 350 to a 466, that's a 582, above previous peaks at 550. Amazon near term already crossed the tip of the W above 258, closed near 271. That measured target just near term is above its previous peak at 278, near 291 is where Amazon could climb. Semiconductor ETF SOXX head and shoulder breakdown, measured target is towards like from a 536 to a 656, $120 less at 416. However, it beautifully tested key support at 464, rebounded. However, Friday's was a bearish candle. So you got to watch. If this 464 breaks very quickly, we could see momentum to test this rising 200 period moving average at 402. That would be a beautiful buying opportunity because we know that semiconductors are not suddenly just going to go away. AI spending is huge. CapEx spending has been reaffirmed. AI will continue to be driving the economy moving forward. Semiconductor stocks will be an ideal buying opportunity on a pullback like that if you get a 200 period test on it. So wait for that opportunity. If you do get the 200 period, one heck of an opportunity to start going long on the semiconductors. So that's the SOXX, the head and shoulder. And on the daily chart, there's also a kind of a declining channel. If this fails at the top end of the declining channel, then a breakdown again below bottom trend line towards the 200 period is something for us to look into for those that are wanting to go long on the semiconductors. QQQ, that breakdown from the descending triangle pattern is near 623. The rising 50 period moving average is 633. And also there is, in this particular case, a repetition of what happened in March, right? Falling wedge pattern, which often ends in a bullish reversal. So this next bullish reversal is very much possible out of this pattern. That said, a near-term breakdown below that wedge, just kind of a shakeout of the kind of, the last few bulls, and then, and then it starts climbing higher is a possibility, which could repeat of this here. And then we get that quick test of the 200 period, and from there, a climb higher. The summation index is getting deeply oversold like we had in November and March. However, these are 3-week periods over which summation index bottoms out. We are into 2 weeks. Another week, next week would be key. Could be a great buying opportunity if you could see the summation index bottom out. And then that's an intermediate cycle indicator. From then market starts climbing. So the next few months, we potentially could get a climb out of it. One contrarian bullish sign has been that the bullish percent index did climb from that lows of last Friday. So while the market tested a lower low in price, bullish percent index did not confirm that. It did not print a lower low. It printed its low last Friday. Market printed or low on Wednesday, right? At that 661, not the bullish percent index. Bullish percent index printed a lower low last Friday. And then last 5 days, it has been climbing. So now this is at a lower high though. Potentially, if we do get that drop of QQQ like we got in late March for a few days below the bottom end of this falling wedge, then potentially BPNDX could come down, but at a higher low from there, start climbing is what we're going to watch for. Good luck investing. We'll talk to you next week. Thank you so much.
We are not registered investment advisors and encourage our users to consult with their financial advisors before making investment and trading decisions. Nothing contained in our content constitutes a solicitation, recommendation, endorsement, or offer by us at Chartsarefun or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction.